Hi there, welcome to kneppyinvests. I'm actually really excited to be doing this video today in which I'll be looking at the performance of companies that listed on the ASX in 2016. Originally, I was just going to do one video on this topic, but I came to the decision that I am going to rate every single company on the ASX that listed in 2016 and is still trading on the ASX. So they haven't delisted. And because there are quite a few, and I don't want to do all companies in the one video, I'm breaking this down into numerous videos. I'm not sure how many, because there are quite a few companies that did list in 2016. I'll be looking at 10 companies in each video, and I'll be giving all companies a rating. The original motivation behind this video was a website I did discover recently, and I'll show you that website in a second. And in this website, you have the capability to go back to 2016 and see all the companies that did list in 2016, and they just looked at the share price performance since those listings. Now, I did know about two IPO websites that I do look at quite regularly, in particular one. I'll also show you those two websites, and if I do remember, I'll leave links to those three websites in the description of this video. I'll be focusing on 10 companies per video, going in chronological order. So starting with the first company that listed and then going down that way. So there's no bias or anything in regards to which companies I look at per video. And I'll be grading every single company that did list in 2016 that is still traded on the ASX. We will see a lot of companies that did list in 2016 that have delisted since then for various reasons. In fact, in this first video, there were numerous companies that did list in the first period of 2016 that are no longer traded on the ASX. And I'll go through the reasons why those companies are no longer trading on the ASX. And I'll grade every single company that is still trading based off their financial and share price performance since the first day of listing. So if you bought into the IPO, how happy would you be 5 years later? And I'll be using an A to F grading. I have discovered two websites in the past few years that I do visit regularly in regards to IPOs. The first site here is Small Caps. They do have an IPO section, and you can look at upcoming IPOs and then go through history and look at IPOs over the past 4 years from 2017. So if you go back to 2017, towards the end of that year in December, quite a few companies did list on the ASX, including National Tyre and Wheel Limited, and they'll tell you how those companies have performed in regards to share price. For instance, National Tyre and Wheel Limited have had a 9.5% return. Share price has gone from $1 to a current share price of $1.10. Wagner's negative 33% return from $2.71 to $1.80. And P2P, they've gone into administration. I think they're some sort of taxi company, no longer listed on the exchange because administration. So you can go to this website, go through all the IPOs since 2017 and just see how companies have performed. And I've used this quite regularly. You also can look at upcoming IPOs, but actually I use another website for that, and I'll talk about that website right now. 61 Financial is perhaps my favorite IPO website. They have two functionalities here that I do like, and this is the first one. This is focusing on companies that are just about to list on the exchange. And they go into great depths if you hit the More button, and it'll bring up a lot of information about these companies that are going to float on the ASX in the near term. Now, down the bottom of this page, if you hit the More, it'll bring up even more companies, but these companies aren't about to list on the ASX. They are companies that have already listed on the ASX. And again, if you hit the More button, a lot of information comes out on these companies that have already listed on the ASX. I love this functionality that 61 Financial are doing, and I do use this quite frequently to look at companies that have just recently IPO'd on the ASX. The second functionality I do like which I'll show you now, is this little bit of information that 61 Financial do provide for companies that have listed on the ASX in the past year. So it's only 1 year of data, and it breaks down the share price performance of all companies of 5 days, 20 days, 60 days, 100 days, and since IPO. For instance, almost 1 year ago, Aussie Broadband did list on the ASX. And since it did IPO, the share price has increased 388%. And then we can break it down to see how it performed in the first 5 days, up 100%, first 20 days, 94%, 60 days, 112%, and the first 120 days it listed on the ASX, it was up 177%. So you can see a lot of companies did list about a year ago. We had Aussie Broadband, mydeal.com.au, Adore Beauty, Clean Space, Zebit, Credit Clear, Dusk, DC2, High Pages, and Universal Store, and Harmony, and Home Company. So a lot of companies this time last year were listing on the ASX because the share price or the market itself was on a bit of a tear, and that's the best time to list your company on a publicly traded exchange. This is the website I recently discovered that was or is the main motivation behind me doing this video. And that website is IPOwatch.com.au. They have a scorecard section which does show you the performance of all companies that have listed on the ASX since 2016. And here is the first group of companies that did list on the ASX in 2016, straight from IPOwatch.com.au in chronological order. I'm going to go through all these videos. I'll be focusing on those companies that are still traded on the ASX, but I want to touch upon those companies that are not traded on the ASX no longer, those companies that have been delisted for various reasons. In fact, the first company that did list on the ASX in 2016 was a company called Total Face Group, and they changed their name to Wellness and Beauty Solutions. They weren't performing very well, and they went into administration March 2021, so they've gone bankrupt. The next three companies that did list in 2016, you can still buy and sell on the ASX. They are Reece Limited, Novarti Group, and iCanty Interactive. So I will be ranking those three companies' performance over the past 5 years. The next company that did list, Global Fortune Investment Limited, was a dodgy Chinese company. They were suspended for 2 years from trading for some reason or another, and then because of rules on the ASX, if you are suspended for 2 years, you automatically become delisted. They were delisted in June 2020. There will be a theme in this first group of companies, a very common theme in regards to why they're no longer listing, and see if you can pick up on this theme. The next company, Henry Morgan Limited. This was a dodgy non-Chinese company. I think Henry Morgan and another company called John Blackmore's or something were named after famous pirates, and both companies are no longer with us. Quite dodgy stories, both of them. Our next company I'll be looking at in this video will be Vectus Biosystems, and then Buy My Place changed their name to Ecosystems. For some reason, they were suspended for trading for 2 years and then delisted in October 2020. And then we had a group of dodgy Chinese companies. We had Ding Sheng Jin Finance. That was a really dodgy Chinese company. I think I called that really dodgy because they told their shareholders they were going to issue a dividend, and they never paid their dividend. And the ASX did not like that and delisted that company in May 2018. We had 4 companies that are still with us: Tesseract, Oneview, Soon Mining, and N1 Holdings. So I will be ranking those 4 videos. And then we had another 2 dodgy Chinese companies: JC International, they delisted August 2020, and China Dairy Corporation, they delisted July 2018. I think there would have been a little bit of hype around that company just because they were China Dairy. And then we had probably one of the best performing companies that listed on the ASX in 2016, Wisetech. I'll be talking about that company in this video and ranking that company. Then we had 2 companies that are no longer listed on the ASX, not because they're dodgy. The first one is Monash Absolute Investment. They were restructured into a ETMF. I didn't know they existed. That's an exchange traded Managed Fund, and they delisted May 2021, so recently. And then Abundant Produce, they delisted June 2020 and became a private company. So they are still in existence, still. You can buy that company if you know how to buy and sell shares in a private company. And the last company I'll be ranking in this video is Volpara Health Technologies. Did you notice any sort of trends in those companies that did list on the ASX in 2016 and are no longer trading on the ASX? I think it was pretty obvious. There were quite a few dodgy Chinese companies that did list in the beginning of 2016 and are no longer with us right now. It was a problem in regards to Chinese companies that did list on the ASX, and I wouldn't call them scams, but they didn't list on the ASX for the right reasons. For instance, I do believe a lot of these companies did list on the ASX so shareholders, Chinese shareholders, could take their money out of China and put their money into Western countries. I do think, if I remember correctly, Chinese nationals would have a hard time to get money out of China. And this was one vehicle they did use to be able to do that. And I do think the reason these companies list on the ASX was for the wrong reason. I myself was induced by one such company who said they had $30 million of cash, yet had a market cap of $5 million. I decided to take the risk, but after a period of time, I realized the risk wasn't worth it, and that company is no longer traded on the ASX. And this is an article from, I think it was ABC, talking about 6 Chinese companies that had to be delisted by the ASX in 2018, prompting experts to urge investor caution, and a quote from editor-in-chief of InvestSmart, Alan Kohler, who said, "I would be very careful about vesting in any ASX-listed Chinese companies. Many of them I wouldn't touch with a barge pole." The first company we'll be looking at in this video is Reese Pharmaceuticals, the first company that listed in 2016 and is still with us. The main thing with Reese Pharmaceuticals is the share price performance over the past 5 years. I don't really know a lot about this company simply because they have zero revenue, so they have nothing in production. I think they do something in regards to antibacterial solutions or something like that. But the share price has risen 385% since the IPO, even though between 2016 and 2019, share price went nowhere, even down a little bit. But the share price did rise quite a bit in 2020. In fact, it went from a low of 25 cents to a high of $1.88. So shareholders would have been really happy during that period. Maybe over the past year, they've become a little bit more nervous because the share price has pulled back to 96.5 cents. Market cap of 170 million, operating cash flow negative, shares on issue have more than doubled. But if I bought into the IPO, it's around about 25 cents. With the current share price of around about $1, I'd be quite happy with the performance of Reese Pharmaceuticals at this point in time, because if I was a shareholder, more than likely the reason I'm still holding onto the shares of this company is because the story, I do like the story of this company. I do like where they're heading in the future, and I do believe that the revenue will climb once they go into production, whatever they are going to sell in the future. So the main thing with Reese Pharmaceuticals is the story. Do you believe the story? But based off the share price performance, I'm going to have to give Reese Pharmaceuticals a B+. Next company that listed on the ASX in 2016 is Novarti. There are some things to like about this company and some things I am a little bit wary about. The things to like: share price up 135%, not quite as much as Reese Pharmaceuticals, but still the share price is up over 100%. Market cap 155 million, that's nothing to be concerned about. Revenue has more than quadrupled in 5 years, from 3.9 to 16.5 million. That is probably the best thing about the performance of Novarti, is the revenue growth over the past 5 years. Now to the negative things. Operating cash flow has become an issue. So in the past year, they bled $5.4 million in the operating business. I think they do have to correct that, because if they continue to bleed cash in their operations, they'll have to raise more capital in the future. And the shares on issue have more than doubled over the past 5 years, growing from 110 million to 244 million. There are things to like. Some things to not to like with Novarti. I do like the revenue growth. The share price would be happy, or would be shareholders would be happy about the share price increasing 135%. Overall, if I was a shareholder from the IPO, I'd be mostly happy with the performance of Novarti. Just the operating cash flow is the one thing that would make me a little bit less happy. But overall, I'd give Novarti a B rating. iCandy is the next company we're going to look at. Not a lot of things to like about iCandy. Share price down 55%. Market cap 51 million. Nothing to like or dislike about that. Revenue has grown, but not growing all that much, from 1.6 million to 3.6 million. They are operational cash flow positive. That's in 2021, $400,000. Shares on issue have more than doubled, not quite more than doubled. They've increased from 229 to 547 million. But the main things to dislike about iCandy is mainly the share price is down 55%. So if I'd bought into the IPO for iCandy, I'd be very disappointed with the overall performance of this company, particularly with the share price. So I'd give this company a D rating at this point in time. Next company I want to look at is Vectus Biosystems. If you ask me with a gun to the head what this company does, I could not tell you. I'd probably make something up about pharmaceutical company just because of that Biosystems. So again, I know nothing about this company. I'm just judging Vectus Biosystems on the share price and the financials over the past 5 years. And when you look at the financials, nothing to get too excited. Zero revenue, operating cash flow negative in the last financial year of 3.3 million, market cap 46 million, share price down 5% since 2016 when they listed. But when you look at the chart, it's a tale of two halves here. The first half between 2016 and midway through 2019 was not a good story. Share price went down to 30 cents. But since that low of 30 cents in 2019, we've seen the share price rise to $1.50. So the share price has gone up fivefold. Not only that, we've seen the volume increase through that period. And that is telling me the market is getting excited about this company. I don't know why. I'd have to do a little bit of research. So when I break down Vectus Biosystems, they're doing nothing financially. Maybe in their research, they're doing a fair bit. The share price has rebounded over the past 2 years. So I'm fairly neutral about the overall performance of Vectus Biosystems over the past 5 years. And that's why I've given this company a grading of C. On to the next company, and I do have mixed feelings about the performance of this company since they listed on the ASX, because when you look at the share price, it's only risen 10%. So if you're a shareholder from the IPO and you've held onto your shares, you might have mixed feelings because a 10% return in 5 years is not actually very good. But the market cap has actually increased by about tenfold during that period. And the main reason the market cap has increased tenfold, but the share price has only increased 10% is because this company continually does capital raisings, so the shares on issue continually climbs. In fact, they're doing capital raising right now. Shares on issue have increased from 100 million to 1 billion. But the share price performance probably has underperformed, underwhelmed over the past 5 years. But the financial performance of this company have really done well. Revenue increased from 4.7 million to 67 million. And Tezzeret right now is operational cash flow positive. In fact, in the June quarter, they were operational cash flow positive by over $5 million. So it seems like the plan of the management is coming to fruition. This acquisition frenzy they have been going through is working. But I do think there are parts of the shareholder base that are getting frustrated with this company continually doing capital raisings. It will have to stop eventually, and this company will have to grow organically. So overall, the share price performance has underwhelmed. When you compare, or when you consider the share price has only increased 10% in the last 5 years. But financially, this company is doing well. But overall, I do have mixed feelings with the performance of Tezzeret. So that's why I've given Tezzeret a C+ rating. The next company we are going to be looking at, Oneview, is a sort of a company where if you judge the performance of Oneview over the past year, in 2021, you might have quite a high rating because the share price has risen by quite a bit. Not only that, we've seen a lot of volume come in, so the market is getting interested in this company. But I'm judging Oneview's performance since they IPO'd. And when you do that, this company has not performed well at all. Share price is down 88%. And even though the market cap is $175 million right now, I'm not sure the financial performance justifies that market cap. Revenue has actually dropped over the past 5 years, falling from 13.1 million to 11.3 million. And the main concern I have with Oneview is the operating cash flow negative state of the company. It has improved over the past 5 years. So 5 years ago, they lost $25 million in operating cash flow. Now it's only down to $12 million they have lost in operating cash flow. And because this company is bleeding a lot of cash, the shares on issue have increased sixfold over the past 5 years, increasing from 61 million to 395 million. So in my opinion, it's just my opinion, not a lot to like about this company over the past 5 years. Share price down 88%. Operating cash flow negative by 12 million. Revenue has actually dropped. I'm not sure why there's been an increased interest in this company over the past year, because I haven't really been following this company at all because of what's been happening over the past 5 years. So if we judge this company's performance over the past 5 years, I'm going to have to give this company an E rating. We've already talked about dodgy Chinese companies, and if you thought that story had come to a completion, you would be wrong, because it looks like that Su Mining Limited is another dodgy Chinese company. They last traded on the 27th of October 2020, so they have been suspended for nearly 1 year. And even leading up to when they were suspended, the company's shares were only traded twice in a 2-year period. So I'm not even going to look at their financial state because they wouldn't have any financials. All I have to know about this company is they are another possible dodgy Chinese company. So this automatically gets an F rating. I'm not sure I've mentioned it, but all the charts I'm showing in this video are weekly charts, not daily charts. On to the next company, and I might be a little bit harsh about the performance and ratings of N1 Holdings. And I think mainly when you look at the rating, it's based off the share price, what it's done over the past 5 years. Share price is down 50%. And this company's shares are infrequently traded, so it is liquidly traded. So that's the main reasons I do have a fairly low rating for N1 Holdings. But when you look at the financial state, there are some things to like about this company. Revenue has grown, albeit slowly, from 3.4 to 5.4 million. The market cap is only 8 million. They are operational cash flow positive, 1.3 million in the last financial year, and shares on issue have not grown. So this company is self-sustainable. So maybe I am being a little bit harsh by giving this company a D rating. Maybe a C rating would be more applicable, but I'm just focused on the fact that the share price has decreased 50% and the shares are illiquidly traded. Second to last company I want to look at here is Wisetech, and to be fair, I shouldn't have to give you my rating for this company. It should be quite obvious when you look at the share price performance and financial performance. Share price up 1,467%. That should be an A rating. Market cap 17.3 billion. Well, I'm not rating company on their market cap, so that's irrelevant. But when you look at the revenue growing from 103 to 508 million, that's a 5-fold increase. That's an A rating. Operating cash flow has increased tenfold from 21 million to 212 million. That's an A rating. And even the shares on issue hasn't increased all that much, rising from 291 to 325 million. So everything points to Wisetech being an A+ rating. You cannot argue against that sort of rating with this company. Final company I'll be looking at in this video is a company we should all hope that will succeed in the long term, because this company has breast cancer screening technology. And if they are successful, it will be great news for humanity overall. So go Volpara. I really hope you succeed in the future. I'm not a shareholder, but I still hope this company succeeds. Share price up 142%. So that is one good thing to like about this company. If you're a shareholder of Volpara since IPO, you would love that share price has increased 142%. Market cap of 306 million might be a little bit stretched when you look at some of their financials. So I do think the market is pricing in a lot of potential in the future in regards to this company. Revenue, though, in saying all that, has increased from 1.7 million to 18.1 million. So they are gaining traction with their products, with their screening of breast cancer. But the main thing to dislike about Volpara is their operating cash flow. It's actually got worse over the past 5 years. 5 years ago, they were negative in operating cash flow, 7.5 million. Now they are minus $12.5 million in operating cash flow. That's a lot of burning cash they have in operations. Because they are burning a lot of cash, they do have to raise some capital. So shares on issue have increased from 144 to 251 million. There are things to like about Volpara, but there are also things to dislike. So I'm going to give this company a B rating right now, based off mostly because the share price has increased 142% and the revenue has really taken off over the past 5 years. But it's just that operating cash flow, minus 12.9 million in the last financial year. That is the one concerning thing I have about this company. In part 2 of this video series, not a lot of companies that are no longer listed on the ASX. So between April and June 2016, a lot of those companies that did list are still trading on the ASX. One of those companies is under a different name. So Shark Mitigation Systems is now Harvest Technologies. Afterpay I might not be looking at Afterpay, because even though IPOwatch.com.au says Afterpay listed on the ASX in May 2016, they might be wrong. I do have maybe not confirmation, but ASX website says Afterpay actually listed in May 2017. So IPOwatch.com.au might be up by 1 year. But we're definitely looking at Motorcycle Holdings, Reliance Worldwide, Redbubble, WAM Leaders, GTN, Tegel Group, Nine Spokes, and Live Hire. That's all I have for this, part 1 of IPOs of 2016, looking at the performance of all these companies that did list on the ASX in that year. Hope you've liked this video. If you do have any suggestions or any thoughts or any questions in regards to this video or any companies that I did look at in this video, make sure you leave it in the comment section of this video and I'll get back to you as soon as possible. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone that is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.